We all got that? Walter? We're good. Take it over, Greg.
So something weird's happening when we're all standing over here, which is not how we usually start out. I don't know if the panelists are waiting for walkout music. There you go. But so you can go ahead and take seats. And because I do panels differently. Some of you have been to my panels before, and you'll find that I flip everything in reverse. A lot of it is so that I don't have to do any work, kind of like Chad, letting Sharon find the panelists. I let the panelists introduce themselves. In my defense, they can actually do a better job of it than I can. While they're doing their introduction and tell everybody a little bit about themselves and what they do, what they've done, I need you guys to help me think of questions, because what we do is, although I do have the break class in case of emergency questions that I've put together and discussed with the panelists ahead of time, what we really want is the questions to come from you. We're not going to give the answers right away, but we want the questions to come from you. I'm going to write them up here on the whiteboard. You will not be able to read my writing, so apologies in advance, but you don't need to read them because I will ask the questions. At the end, we'll do a traditional Q&A session, but try to make it as interactive as possible, keep you guys guessing when the question will come up. It helps keep everybody awake. So I will start at the very end, and we'll do introductions.
Hi, I'm Hanna. I am a technologist, an entrepreneur. I've helped build 5 companies in the Valley, going back to the dark ages of '95. I serve as an investor and advisor and board member to a number of companies, including Lyft, Lending Club, and Kiva, where I serve as executive chair of the board. That's about it.
Hi, I'm Kadavy. I work at Charles River Ventures, doing mostly very early stage investing, primarily seed and Series A. So the boards that I'm part of are very, very young boards, which in some ways look the same, and in some ways look nothing like what many of the other boards I'm sure people will talk about spending time on today does. Some of my recent investments boards are marketplace companies. They're very young, some of which you've probably never heard of. A few you may have. One is DoorDash that does food delivery. Another is ClassPass that does a subscription gym membership to boutique fitness studios. And then a few other very, very young ones that I hope you all know, but probably not yet.
Hi, I'm Annie Wayne, and I am the CFO of Revel Systems. Revel Systems is a revolutionary iPad point-of-sale system. Prior to being a CFO at Revel Systems, I was the CFO of Bizo, which is a marketing targeting company that was sold to LinkedIn recently. It was, up until last week, the largest acquisition LinkedIn ever made, but lynda.com really threw that out the window. I've been the CFO at several other startup companies here in the Valley, and started my career at Pricewaterhouse, and then spent quite a bit of time at McKesson Corporation, so I had an opportunity to be in the corporate world before moving to startups.
Hi, and I'm Sharon Wienbar. I'm a partner at Scale Venture Partners. We're a venture fund based here, but investing nationwide. And we invest in companies that are early in their scaling phase. So after there's product market fit and a channel to market that is working, we come in and make investments and really try and help the company grow, especially their sales and marketing practice, and dramatically ramp the revenue and value creation. Prior to being a venture capitalist, I had 2 past lives as a Bain & Company consultant and then as a marketing executive in technology companies.
Hi, I'm Dana Evan. I'm a recovering CFO, I like to call myself. I was the founding CFO starting in '95 as well, with VeriSign, and I was there for 12 years. While I was there, I was on the board of Omniture and MySQL. I left in '07, and a couple years later, we sold both of those companies, Omniture to Adobe and MySQL Sun. And now I'm a professional board member. I sit on 7 boards, 4 of which are public. And I'm also a venture partner at Icon Ventures. So some of my companies I'm working with right now include Box, Criteo, SurveyMonkey, Proofpoint, and Everyday Health, where I sit on the board with Sharon.
So as promised, I will turn to you. Because otherwise, we have to go with my questions, which won't be as good as your questions. We have a first.
Along the lines of getting the board to present to us what we don't know. What kind of questions or leading questions can we ask of the CEO at board meeting to find out what charts or graphs or data should we be seeing that are not being presented to us? And obviously the CEO is not going to volunteer that to us.
What sort of key performance indicators should a founder look for to measure their board?
Attendance.
Usually they're looking for key performance indicators to measure the company, not measure the board, so that's interesting. It's a very interesting question.
Yeah, how often is the board meeting on an annual basis for, in a startup environment? Frequency, what is the frequency?
I would say cautionary tales of problems that have arisen on a board and steps you would have taken to prevent that. Considerations, if any, for being a controlling board member.
Guidelines for selecting your board members.
Particularly for Dana, what's the range of how much are the board meetings and board composition running along the same lines versus different companies that have 7 boards?
How much variation is there in terms of how boards run their meetings?
Dynamic meetings, key issues.
Any advice on transitioning from, in an early stage, from an advisory board to a full-blown board?
Guidelines for changing the board composition, like if you have to remove board members, how do you?
Very carefully.
Since the panelists are all female, I'd like to understand the importance of gender diversity in the board makeup. This was planned.
Okay, how do you approach alignment or conflict resolution amongst the board members?
Best practices with regard to clarification of roles between CEO, chairman, and majority holder when you have a private, closely held company.
Three more.
Yeah, what is the decision process for the board making some important decisions? What is the process for that? And how much support information they need to make that decision?
Can some of the panelists share how the board opportunities came about or ways to join the board?
I think in some cases it's because people lose bets.
Stories from watching first-time entrepreneurs build boards and sort of sharing what works and what doesn't work from a heuristical perspective.
It's actually related to the earlier discussion. Advices for the first-time founders to form the initial early board.
one more, and then I promise we'll do Q&A at the very end, in case somebody didn't get a question. Somebody doesn't get a question.
I'd like to hear a bit more about the difference between a professional board member and someone who is perhaps a CEO or CFO of a company and on a board of other companies. Pros and cons.
I will.
Testing new opportunities, what are the things the board can tolerate and cannot tolerate?
All right, we've got a lot of good questions, and because of that, I'm going to start with one that's not on the board. But I do want to kind of set the stage and let each of the panelists, general, what is your role as a director? How do you, each of you, because everybody comes into a board situation thinking differently about what their job is, what their responsibility is. And so, and obviously it's going to be different for each of you in different situations, but big picture, how do you think of what you're doing there? I'll start. Let's go down the row on this one. Yeah.
First and foremost, I prescribe to the frame of servant leadership. And so when I think about, and one of the reasons that I moved from, when I moved from kind of operating roles and being a CEO to committing to doing board work was I found not enough people, in my experience in building my own companies, took their board responsibility seriously enough. And it's easy to kind of be a dilettante and swoop in and advise from a place of theory and then say, good luck with that, and run out the door. And yet, boards can be an incredibly powerful strategic asset. And so what I became interested in is how can you create a high impact, high functioning, highly effective board? What does that look like? And why are most boards not that? And so one of the things that I do kind of ground my philosophy in are two things. One is servant leadership. You're there in service to the company's mission. You have a role of accountability and responsibility. The CEO and management are accountable to you, but that doesn't mean that you're really their boss in the traditional managerial way. And you're in service to the company. And so there's a humility that I think is important that comes with that, and an awesome amount of responsibility. The other thing that I would just add to that is, again, having been a CEO, the thing that I found very helpful and rare was having board members who could be a trusted advisor. And so what I try to kind of bring is a radical empathy to the CEO and to the management team, because again, it's advising, steering, guiding, not being directive from a place of having walked a mile in their shoes really is very important to building that trusted relationship. So that, and my litmus test for it is, when the chips are down and there's a crisis, will the CEO call me up and say, oh crap, I don't know what to do, and not have to fear. Because what you want to do is have the real conversation. So much is about how do you create the conditions to have a real conversation about the tough issues, all the upside potential and the downside risk, and to feel like you can be vulnerable enough around the tough issues without having to kind of protect or defend or manage information, which is code for controlling the board, not managing the board. So.
I think that a lot of that resonates also. Two things. One is to be a mirror to the CEO or to the founder, which in my case is always the same person. In an early stage startup, when things are changing and moving so quickly, if I meet with them every month, every 6 weeks, oftentimes it can be, in many ways, a completely different business than it was a month before. You hope not like completely different. But things are moving really, really quickly. They may have hired 5 new people, they may have opened a new market, they may have figured out a customer acquisition channel that they didn't know was going to work as well or as poorly as they expected. And so I think a part of my role is to think, what are the things that we've talked about in the past? What are the goals that we've had? Where has the company been? And let me be the mirror to you to say, this is where we've come from, this is where we said we were going, are we getting there? And if yes, be a supportive, enthusiastic kind of friend and ideally trusted advisor. And if not, also be very honest and open of, well, why don't we think we got there? What did we have wrong? You know, where can we go from here? So having those honest conversations and just being away, you know, when an early stage founder is like, you know, you're in the weeds, you're doing this every single day, but to pull up and say, oh wow, I can actually take a minute and breathe and look at what I was doing 4 or 6 weeks ago and see how far we've come and what we've learned, can oftentimes be very helpful. And then the other thing I think, you know, I generally believe VCs are not very good for much. But one thing that they can be quite good for is that their job is to watch and try and be as helpful as they can. Small companies turn into really big companies, and so this pattern recognition of, you know, okay, you're a 10-person company now, when you're a 20-person company, here are some of the things that we've seen 100 other companies struggle through, a lot of more similar than different challenges. So let's start thinking about those now so that by the time they show up, you're like, oh wow, we actually thought about that as opposed to this is blindsiding me.
So my experience, I'm on the management side and acting as a CFO. My role in board meetings and contributing to the board is really to build confidence and to provide insights into the company, metrics, and to make sure that the CEO and the board are looking at the company in ways that are more objective, and to make sure that those, that the way I'm presenting it and the way that we're explaining it, both the CEO and myself, is such a way that everyone understands and it's clear that what we're providing can allow them and allow us as a board to make decisions to drive the business forward.
Yeah, so I think of my role as sort of a guide for the company to help it in achieve its ultimate potential. And first and foremost, to avoid pitfalls, especially avoid pitfalls that are known pitfalls to other companies, but this company may not realize it, right? So if you minimize the downside risk, then you can really focus on what does the company have to do to achieve its upside potential. And you know, and that's a lot of the fun work of being on a board, is helping the company think through its strategy, think through its partnerships, think through market expansion opportunities, and then all the operational aspects that would go into achieving that. So it's kind of, if you can keep the down, you know, to a minimum, then you can really focus on the upside. I think 2 things really help in focusing on the upside. One is embracing factual decision making. So you know, there's a whole lot of puffery and spin and sparkle hands in Silicon Valley companies, and you know, but inside the company, the weird thing is, especially for a CEO, you have to play that game, right? Both to motivate your employees and your partners, and to sort of bully your way into the market before you really have that position. You're asserting the right to be there. Yet when you're inside the company and with the board, it really pays to actually be very factual about the actual traction you have, the actual cost of getting that traction. And so, you know, you have to be able to kind of strip away that veneer of all the marketing puff. The second place where I would say I spend a lot of my time with my CEOs and teams is on personnel-related matters. So both making sure that you have the right people on the team at the time, that you're thinking about the organizational capabilities that you'll need as the company ramps, and where might be that pipeline of talent. That's true both for the board as well as for inside the company. You know, I was grateful to Dana to help us, you know, bring our company forward together as a public company. And then also navigating a lot of the sticky interpersonal dynamics that happen among the teams. So, you know, most companies are multi-founder companies. In fact, you know, a lot of venture firms won't fund single founder companies. But there are a lot of dynamics that happen among founders as the company scales, and in particular, if not all the founders kind of scale at the same rate. And sometimes those dynamics can actually impede the business because there's an undercurrent, underground tension that's stopping the company from taking the next step because of these interpersonal dynamics. So that's a place where I spend a lot of time. It's sort of like being a psychiatrist. But I think it helps evolve the organization forward.
Lots of great things, ladies. What I'd like to add, and I'm going to actually kind of loop in a little bit of an answer to another question that was had. So when I was on the board at Omniture and MySQL, when I was at VeriSign, I was working 60, 70 hours a week, right, traveling all over the world. So what I brought to those board meetings at that point in time is very different than what I bring to the board meetings now. So sitting executives are very valuable, but they don't have the time to be this consultative advisor that a board oftentimes is looking for. So the difference now is that I spend a ton of my time being very consultative with my CEOs and CFOs. Just this last weekend, I was on the phone with 3 of my CEOs, 2 public, 1 private, all different matters, and they know that they can text me, they can call me anytime, and I'm there for them. Everybody wants to build a $1 billion business, and we built a $2 billion business at VeriSign. So they're looking for me to help them with everything from infrastructure build out, organizational design, leadership development, interpersonal matters, and M&A. We bought 57 companies at VeriSign, so I was very busy this weekend on the M&A front. So it's very consultative, and it's a lot more rewarding for me personally to be able to be involved now. Now, I join boards of companies at a much later stage, typically not till they're at least 50 to 100 million in revenue. So you tend to have a little bit different problems. But I still, my CEOs and my CFOs and the management team know that I'm there to help them build a $1 billion business, which is what everybody wants to build, and that I'll do anything, I'll be there, I'll jump on a plane, go to meetings with them, I'll go visit customers, I'll go visit potential acquisition targets. I mean, I'm there as their trusted advisor. Now, as a board member of a public company, I also have a fiduciary responsibility to the shareholders. And oftentimes with founders, that can be a difficult thing too, because everyone wants to go public, or most people want to go public, but then the founders tend to forget they don't own the company anymore. They still own a piece of it, but they don't own the company anymore. And so oftentimes that comes with its whole set of challenges, and a lot of times I'm the one sent in to have the discussion with the CEO, like, I understand why you want to do this, it makes sense, but here's how you need to think about it, because oh, by the way, you've got Fidelity and T. Rowe and Putnam and Janus and all these guys that are expecting maybe something a little different from you. So I think being consultative is key, and it's what adds value, and I think that's that's what most management teams are looking for. And it's not your job as a board member to run the company, right? Your job is to be consultative, guidance, to lead them, help them execute strategy, help them grow and build a great business.
Yeah.
Just a note.
Just a note on that, since you touched on the sitting executive, is it all right if I add something now? There's a post I keep wanting to write called "Waterboarding the CEO," and it came out of an experience of having my first role as an independent director, and so I was very excited to bring all my operating experience as a CEO to the boardroom and help management. And so I was full of advice. I had a lot of great advice. Do this, don't do that. Let me tell you, you're going off a cliff if you do that. And I was, as much as I thought I was being helpful, I was actually quite obnoxious, it turns out. And at one point the CEO had asked me to join him to help recruit someone to the board who had been a peer CEO of mine, and I'd known him for a long time. And so the 3 of us go out for a glass of wine, and the prospective board member turns to me and says, "Hey, how is it to be an independent director? How's it different from doing that as a sitting CEO versus as an independent director?" And I said, "Well, it's been a really interesting experience. Probably the biggest learning, the biggest difference is that you realize you can lead the horse to water, but you can't make them drink." And the CEO of the company I'm on the board of said, "Yeah, and in Julie's case, if you don't drink, she dunks your head under the water over and over again."
That's great.
And that was my part. I went, "Oh my God, I've been waterboarding the CEO." So I think that's kind of one of the art of being a good board member is there's an indirectness to guidance, and you'll hear the words guidance and steering a lot, rather than that directness when you're in an operating role in terms of how to get things done.
And I think too, when I've talked to CEOs before I joined the boards, one of the things I always tell them is just remember, I'll be as little or as involved as you like, it's your choice. And, as an example, SurveyMonkey. Dave Goldberg is a very experienced executive, right? He doesn't need the type of guidance from me as a brand new, never been there, never done it CEO does. And so Dave and I have a very different working relationship than myself and some of my entrepreneurial CEOs. So it's just, it's just not one size fits all, but that waterboarding story is great.
A question for the VCs, in particular Annie, because a lot of times the first director that a startup has is a VC. Most of the time, the first non-team director is the VC. How should an early stage company be thinking about the VC recruitment? It's obviously a pitch, but it's also a relationship that hopefully is going to withstand a lot of years. Some say it lasts longer than the average California marriage if for a successful company board. Yeah. How should founders be thinking about talking to VCs? What should they do to make sure that they don't get a VC who's waterboarding them? I'm going to use that.
That's a good question. And, it's a weird thing because both sides in some ways are buying and selling, and you're kind of like doing this weird meeting ritual dance that you see birds do in nature where you're like, I think this is going to be a good thing. What do you think? I think that it all comes down to one thing, and that's trust. And do you feel like you have trust, can build trust? Does this person, going both ways, have a history of being open and honest and authentic and unafraid of saying what needs to be said? To your point of when shit hits the fan, are they going to call you immediately? There's nothing that's more important to me than if the answer to that is yes or no. Because if the answer is no, then you have a problem. If the answer is yes, if you have a high level of trust, anything that happens, you can deal with it. You'll figure it out. It's like, there's lots of articles that relate early investor, CEO relationships as it's like getting married to this person. It's going to last a long time. And I think that's very true. Imagine, being in a serious relationship where you don't have a base level of trust. That's very hard. As far as tactically, how do you do that? We oftentimes will point, new founders that we're investing into our portfolio and say, tell us who you want to talk to, or just call them directly, or we'll introduce you. I'm not going to give you a list of references. You should choose who you want to talk to, because you should be able to talk to anyone who I know or has worked with me before. And that just goes to one more level of saying, I'm going to be totally open and honest and direct with you, and you want to start that at the very beginning.
Is it more important that they talk to references where the company has succeeded or failed?
Great question. I think both are important. If I had to choose one, I would probably choose failed, because you want to understand how that person you're about to build a relationship with dealt with problems and challenges. Did they freak out? Did they yell at you? Did they storm? How did they behave, right? Did they sit down and say, okay, I hear what you're saying, now what are we going to do about it? And let's think about this constructively. And no, this doesn't mean that the company's falling apart, and no, it doesn't mean the sky is falling, and no, it doesn't mean that we need to call Google Corp Dev right now and see if they'll acquire your team. It's let's see if we can figure this out together. And I think that those stories can speak volumes. And I think I have plenty of friends who are CEOs that I'm not an investor in, and that's always what I tell them to do when they're saying, hey, we're lucky enough, we have 2 term sheets, what do we do? We have 6 term sheets, what do we do? First of all, I'm like, can I give you a term sheet? That's amazing. But second of all is it's exactly that. Call the CEOs who have worked with these people before, particularly the ones that have been a struggle. Have they pivoted? Have they struggled to get follow-on financing? Have they had to lay off a bunch of people they work with? And how did that person behave? Were they helpful? Were they supportive? Were they on your team throughout that whole time?
Can I just add some sort of tactical maybe advice to the process of evaluating your potential board members and potential investors? Because so Annie said this, but I'm just gonna underscore it, which is the whole process is of seeking capital is evaluative on both sides through every step of the way, but you kind of have to pretend like it's not. So on the VC side, the VCs, and you're gonna feel this, the VCs are pretending that we like you up until the point that we either give you a term sheet or we don't, because we're trying to materialize an option to invest in the company, right? So we're selling you on us as investors while we're trying to decide we are or are not gonna make the investment, right? Because if we hem and haw, I don't know, you're gonna walk away from us. So we're gonna act enthusiastic about the opportunity, largely because we are. If we're spending time there, we must think there's something really good there. And we're watching how you react through that process. How do you react in sort of stress situations? What happens when we ask probing questions? Those kind of things. By the same token, the entrepreneur should be doing the same thing. Only I think the entrepreneur evaluating the VC part and the formal part of that kind of due diligence, your due diligence on us, typically you have to wait to do some of it to ask for it until pretty late in the process. So, because if you come into the VC relationship and say, I'm evaluating you, what can you do for me in the first meeting, it's going to make it a difficult relationship to start with. So because you're there to sell securities, you should, you're in sales mode most of the time, and then when it looks like you have, multiple opportunities, then you can ask the VC for your references and contacts and things like that. And if you've had time and the network along the way, you ideally had already selected who to meet with in the first place by knowing the firm and the partner's reputation, by maybe knowing some of the people that investor has worked with before. So it's not, so the VC is not a black box, you don't know anything about them until you get a term sheet. But I would say that part where the power shifts to your side is in the term sheet phase, not so much early in the process.
I think the only other thing I would add.
Yeah.
I think the only other thing I would add, and I say this all the time about everything, is that business is personal, and so you should treat it like a personal relationship. And so whether you're picking VCs, you're picking lawyers, you're picking bankers, also super important to pick people that you want to work with, because you're picking partners that hopefully you're going to have really, really long-term relationships with. And you can build a much more successful company with people that you like, trust, and respect. Because when things start to go bad, that's when those things become the most important. Because people that trust, respect, and like each other in difficult situations will always come out on the other side of adversity in a much better place. So,
just elaborate and underscore some points that are made, because I see this being a stumbling block so commonly. I think it's worth sort of doubling down on. The thing Sharon said about what the mindset of the investor is really critical. They're always selling for the right to buy. And they can be very easily confused, that interest can be confused for commitment. And so just always being clear about that. The other thing that I see happens commonly is that the brand of an investment firm is the level of which an entrepreneur CEO will think about raising money. It's really the individual. So you want to actually identify a partner that you want to work with. And of course, the brand and the reputation of the firm is the collection of the individuals. So if it's a high quality firm, the individuals are going to be high quality for the most part, but you still want to know who's the right person that's going to add value to me, who I have the chemistry with. Chemistry is so critical. I mean, I had my own experience of recruiting someone to my board who I was admired deeply, incredibly successful. I had seen him speak. He talked about kind of the culture, the values. He created his own company. And I just thought, wow, he's a perfect fit. And I recruited him hard. I went hard after him. And the interesting thing about it was everything on paper was perfect, but we didn't have the chemistry. And so he was a very competent board member, but because that chemistry wasn't there, his ability to help me and work with me in the ways that I had envisioned were limited. So that chemistry lesson is just really critical. And the best way to do that is to develop these relationships before you need the money. Because it's like dating. So it's great to date when you don't need to get married, because who wants to date someone who has to get married? It's kind of frightening. And the pressure isn't there to really just sort of get to know each other as human beings. The business's personal head tagline is an excellent way of remembering that.
Yeah, the way we think about that last issue is what we say even for our firm, but I also say it to my portfolio companies, is friend raise before you fundraise. So in the fundraising part of the process, you're developing the pipeline of prospects who will be your next investors, and they're getting to know you and vice versa, so that then when it comes time to actually crystallize a round, whether it's for us raising a new fund or for a company raising a new round of capital, you know who the likely people are, you already have a personal relationship with them, and then you can run a relatively quick process that's focused on the specific due diligence items of the moment, but you don't have this, existential who are we and what are we doing kind of conversation with a new investor.
You'd be shocked to know how many deals get their start on soccer fields and softball field and diamonds because of that relationship. It's sitting next to parents sitting next to each other while their kids are playing sports.
The entire B round at VeriSign was negotiated on the soccer fields of Saratoga with Kevin Compton and Clan.
But I think, for people who don't, but I think that kind of comment can sometimes feel very threatening to folks who are not part of the in-group of Silicon Valley, and capital is available to people with good companies who aren't, whose kids are not going to the right private schools in Woodside. What the mistake I often see entrepreneurs make is not understanding who the right potential investors are. So you should think about what is the sector that your company's in, the stage that your company's in, the region your company's in. If you're a seed stage company in New York, there's not, I would posit, don't come to Silicon Valley necessarily for seed stage investors, right? Get people close to home. Then as the company grows, you branch out to broader geographic range. But also understand who's funded your competitors, and so is just on a no-fly list, and you shouldn't be calling them and then getting all offended that they're in a competitive company. But what you really want to look for is investors who have invested in successful analogous companies, right? Because number one, if it was successful, they'll want to do it again. If they were in the failed analogous company, they most likely won't want to double down in that kind of company. So if you're looking for companies that had a similar business model, went after a similar kind of customer, that kind of thing, and look at how they built their capital base and experience base of investors and outside directors, kind of who joined in that young product development phase, who joined in the early go-to-market phase, who joined in the scaling the company phase, and kind of build out, a universe of prospects for that different section, that different stages. Then you can think about how you build your board and your investor base in a really thoughtful way.
Dana and Julie, a lot of our early stage companies have a board structure that's a 1-1-1. There's one common, one preferred, and one independent. And that independent seat sits vacant, I would say. The majority of the hours of the company, that seat sits vacant. Why is that, and when is it the right time to fill that seat, and who?
Well, I'll start. So I think almost in every instance, maybe other than, maybe I was the first independent at Everyday Health. I'm usually the first independent board member people bring on. And typically that person is someone who can serve as audit chair, because that's typically the first thing that needs to happen. I was at KPMG for 8 years, yeah, exactly. But I think also too, you're looking for someone, I ran a lot of operations at VeriSign, and so you're looking for somebody who can come in and help you build your team, build the organization, build the infrastructure. It's a building phase, and so I think that's the first thing to think about. I also think that it's important, if you're really looking for operating help, to get that person in sooner than later. So I'm typically joining boards 2+ years before they're even thinking about going public. So because if you really want to get the value out of it, you really want that person helping you to build your company and making it great. And I always tell people, it's really hard to get from 50 to 100. twice as hard to get to 100 to 250, and 5 times as hard to get to $500 million and then $1 billion. I mean, it gets exponentially harder. So bringing on people that can help with that. But I think what I see with these entrepreneurs tour is that they're hesitant to fill that seat because they have this cozy club dynamic going on, and they're worried that that person's going to be disruptive. And that gets to the point that Julie and I have been making, which is if you bring on the right person who you have chemistry with, who has the experience to help you, and you actually build a symbiotic relationship, then that's going to be a force accelerator going forward to helping you build a good company.
Yeah, I would say there's probably kind of two drivers, and one of the reasons that the board seat is vacant so long is you sort of have the governance driver, and then there's the strategic driver. And then the strategic driver is proactive. The governance driver can oftentimes be reactive, and you're sort of like busy with other things. But if you can be proactive around the independent director role, oftentimes someone who's been a close advisor to the company from the early stages can be a great independent director. And it's very helpful, particularly for a first-time CEO, where there's a lot of things. I know when I'm in the role of independent director, one of the things you can do is really be helpful to bridge the management with investors, right? So there are times when the particular issue or the moment in time will cause those two groups to sit on opposite sides of the table. And having that bridge is important. It's also helpful to be a voice of credibility around issues a lot of times that the CEO is trying to say, but either doesn't have the experience or the context or understanding to say it in a way to kind of influence. That role can be very helpful strategically and in terms of kind of sealing a board dynamic. I do think it's unfortunate that they sit empty for so long, because I've had also the experience of being approached about being a board member in sort of this just-in-time manner. It's like looking at going, oh my God, we really need to have somebody here, we're on the IPO path or what have you. And then there's an urgency about it, and from my perspective, I want to actually have that dating process with the CEO and management and the board, understand how I can really add unique value, not just fill a slot. And so again, taking the time to cultivate that relationship, just like we were talking about with venture investors, is really valuable.
Right, I mean, to be really blunt, I think often CEOs want to leave that position empty because they feel like that at least they have a standoff with the VC, and if they fill that position, then it could be a 2 against 1, and they could lose their job. I have many friends who are CEOs, founder CEOs of young early stage companies, and they're really, really skittish about what happens if the board decides to fire me. So that thought process is running through their head all the time. So the best way to keep your job is keep doing your job well, and then you keep your job. But it's not a win for an investor to have to fire a CEO. So we are dramatically and highly incented to have the CEO be successful. So it's not an adversarial relationship the way often founders are imagining it. The second thing that you can do is you, as a founder CEO, be proactive about filling that board slot with someone who you know. So, which isn't to say that that person is going to be your protector or your buddy or your lackey or your shill, but if you help select the person to fill that role, then at least you can have the comfort that he or she is truly the independent director, not the friend of the VCs.
So let's assume that we have the ideal board. We've got a great board. Annie Wayne, what should a founder team, and it's not just the CEO, although the CEO's the person standing at the front, but what should the team be doing to get ready and get the board ready for that board meeting, whether it's the first meeting or the regular meeting? What's the process that people should be going through to think about how to be ready for a board meeting?
It's a very interesting question. I've seen the gamut of what people do. There's a lot of folks who over-engineer what it should be, and so it becomes this is all the information that we need to give them. Let's sort of death by so much information will obfuscate everything and they won't be able to really figure out what we're doing. I'm sure you guys have all been there. Also, there are those who wait until 2 o'clock in the morning for an 8 a.m. board meeting, and they're throwing the board package together, and they're saying, okay, I got it to the board members before 8 a.m., great. I think there's some place in between those two that is really the optimal place to be operating. I do think it's very thoughtful that the CEO, the management team, needs to be thinking about what are the strategic issues that we need to be sharing with the board and the investors at this board meeting. Somebody asked the frequency of board meetings. I'd like to address that. Being in management, having a board meeting every month when this month is different than next month, sometimes can be so overwhelming because you're just trying to operate the business and you're trying to deal with all the changes that are occurring. So that's a little bit too short. Having it once every quarter is a little bit too long, so I think probably anywhere in the 6 to 8 week range is really good, so that you're not constantly churning this, okay, I'm always managing the board or I'm managing the investors. I'm here to manage the company as well. So I do think that, but I do think having a strategic, what is it that we really need to be sharing, and what is it that we need to be presenting so that we can get the collective knowledge and get the input and really understand how the board can help the company continue to move forward. So are we in a situation where we need, to understand what our go-to-market strategy is? Is it that we need to be asking for, making introductions to, partners, or are we in a position, and I've been at 4 companies that have been purchased, are we in a position where we do need to start looking at M&A activity, either because of the market's ripe, one of our competitors just got acquired and got a very good valuation, or are we at a sort of a fork in the road if we need to go out and do another fundraising round, and do we make the decision, do we just increase our bar, or do we think we can, optimize the value of the organization right now?
Just maybe a few things on that might be useful. One is, something that's often forgotten is the board meeting is the board's meeting. And so one of the things I find common thing that happens is CEOs and management teams will work very hard to put together a package, but actually never talk to the board about what they might want to hear about, focus on, talk about. So it's the board's meeting, which means that the more you know what the board is looking to talk about, it's a dialogue, that the better that's gonna, the more useful it's gonna be. The other is kind of, this gets back to maybe a frame for what is the role of a board member and a board, is kind of basically roughly 3 things. One is, and Sharon touched on a couple of these, downside protection. It's managing for downside risk, which is, at a minimum, it's the governance duty. And a lot of boards only do that. That's kind of traditional boards tend to do. The other is upside potential, which is the strategic board. And then being support to management. Those are really, most, if not everything, falls into one of those 3 buckets. So if you go into preparing for a board meeting with that frame, what do they need to know in terms of downside risk? What do they need to know in terms of upside potential? What do they need to know in terms of support that we need from them? And then what's the level of detail of information and context that's needed, which gets into, the dashboard and the KPIs are the language that you settle on with your board in terms of how to communicate about what's key in the business. And if you can get that language down where everybody feels like we're communicating at the right level of detail, it can do a lot of the heavy lifting around all this over preparation and all the operating detail and kind of overwhelm a lot of times. And the last thing I'll just say is that so often, I think one of the challenges of board meetings is there's this cadence of the business, you're in the details, and then your board shows up once every 6 weeks, maybe, if it's a later stage company, quarterly, and how do you give them the context and information? And 90% of the board meeting will go towards a sort of one-way presentation mode. So I think one of the things to just try to, back to kind of highly effective, highly impactful boards is, how do you go from that one-way presentation mode to a 2-way dialogue? How do you get as much of that information out in advance or as a part of the cadence of the business, what happens in between board meetings, so that when you get to the board meeting, people can sit down and start talking. One of the things we've begun experimenting with actually, and I know LinkedIn does this, and Reed Hoffman and I are on a board together, so we decided to try it on this board, is that walking into the meeting and essentially saying, all right, we've assumed everybody's read the deck, let's go right into discussion. So no presentation. And it really kind of, it forces a shift into this real kind of two-way dialogue where you're not sitting there looking at 100 PowerPoint slides, doing kind of the education and digestion of information, and then there's no time to absorb and kind of be value add.
So who runs that discussion where you don't have the deck to sort of channel it? And to your point about it being the board's meeting, is it one of the directors is it kind of a free-for-all, but how does that actually work?
It's the CEO and the chair working that's a very important relationship, symbiotic relationship. I know one of the things, again, the chair role, particularly in early stage companies, can often be just a sort of treated like an administrative role in the meeting in terms of running the meeting. But it's actually a very important role if it's done to its fullness, because you're orchestrating this with the CEO, the discussion, you're managing the creative tension so that the issues that need to come out are coming out without digressing into kind of polarized debate. So it's the chair and the CEO, and if you don't have a chair, it's the CEO.
I'd like to, one of the things I've seen the most effective along that line is the prep that the CEO and the CFO and the time that they spend with the investors and talking to them before the board meeting and sort of vetting some of these issues or directional things, so that when you get to the meeting, it's not an education process. It's not, so that collaborative, real symbiotic relationship is happening within those dates, so that you're not spending so much time doing that.
That's actually a really good point. As entrepreneurs, and even public company CEOs, CFOs, I have a no surprises rule, and so I don't want to ever be surprised in a board meeting, an audit committee meeting, a comp committee meeting with shocking new news. So it's good CEOs pre-wire things with their board members, and most of my CEOs actually reach out and either, if they're the chairman, they themselves do it. If we have a lead independent director, he does it. They reach out the month before the board meeting saying, here's the things we think we'd like to cover. Here's the strategic questions we're having. Here's, XYZ issues we want to discuss. What are you guys thinking about? Is there anything that you want? And so it's a very collaborative process in coming up with the agenda for the board meeting. And then if there are issues, it doesn't mean you have to spend hours on the phone, but a quick, 10, 15-minute heads up can be very valuable. And then that way, too, you give people time to think about what you're asking them for. What can you help me with this problem? We're going to try to solve this strategy issue. So just giving a lot more thought to it. Because if I get a board presentation sent, and trust me, this happens, at 3 in the morning, because most of these entrepreneurs run different circadian clocks than I am. I'm usually getting up as they're sending the board package. I can't be as helpful if I'm trying to literally read something in the car, on the way to the meeting, because it's been sent in the middle of the night. So, and then that doesn't happen with mature companies, and especially not public companies. But being proactive and really thinking about, what am I wanting to get out of this next meeting? What do I really want to ask my board? Where do I need their help? And then being upfront about it. And don't be afraid to bring bad news. Bring the bad news. Let us help you with it.
Right, two tactics that can really help, I think, create productive board environments. One is having a standard set of KPIs. So what are your financials and your operational metrics that are important in driving the business? And making a standard practice of sending them. And some of my best companies just send that part of the board deck every month after they've done their month-end close. So you know what the trend is. But then the really important thing is that you as management highlight the variances, whether they're variances to plan or variances to trend or expectation, right? So what's important to know? Because if you get 20 slides that have dense Excel spreadsheets pasted into a PowerPoint, it's easy for us to just go page to page, page, page. Okay, I don't see any little red oval highlighting something. I file it and it's done. But if something has changed or you expected to change but you didn't achieve that, you should be letting us know. So that, if you send those kind of packages monthly, and it should be, largely those are the reports that you're looking at as management. You don't have to do, if you're doing fancy special calculations just for us, then either we're asking for the wrong thing or you're not running the business the right way, because we should have a shared point of view about what the key leading indicators are. The second tactic that has worked really well for me, and I think the CEOs I work with, is to have a calendar of specific topics that we're going to talk about at board meetings. So, for example, a lot of my companies have a strategic review board session late in the year just prior to doing the annual plan for the coming year. So you'll have this, what new, where are we going to double down our efforts at, sort of making the strategic decisions for T+1, and then you see those decisions operationalized in the budget that's put forth, somewhere in the fourth quarter, for earlier stage companies, early in the first quarter. But that way you've made those decisions together around what the company's going to try and do the following year, and then you see it in the budget. And similarly, you might follow up throughout the rest of the year with other topics, like whether it's talent development, strategic business development, partnerships, or geographic expansion, things like that, and have those themes so that if somebody, is dying to know what are we doing about, opening an office in, in Southeast Asia, and they're asking that in August, you can say, well, actually in March, we're really going to dig deep into our international expansion strategy, so just, please hold that question.
Can I just expand on something Sharon said that's really important? I see this a lot where there's just kind of two parallel universes that a CEO and management team find themselves managing. There's the day-to-day and all the things that they do to run that, and then the universe of the board and all the information they think they have to provide to run a board meeting. And that's where board meetings and boards can feel like cumbersome overhead because you're trying to get back to running the business. And so the key thing that Sharon said around, either your board's asking for the wrong information or you're managing the business kind of not in the right way is pretty important, because whatever information is being provided to the board, and this is something we talk about often, is and I'm always checking, okay, how much of this was prepared just for the board? Because we don't want you spending a week or two out of your day-to-day job preparing for the board meeting. It can be low production, high value content. We don't need pretty slides. But what's key is that the same information you're using to manage the day-to-day is the information that is being discussed at the board level. When you get into that cadence where there's not these two parallel worlds, then the board meetings don't feel like this massive overhead. Actually, just a good, useful forcing function to step out of the day-to-day and kind of say, okay, where are we? Like strategically, are we on the right path? And then that's where the value of the board meeting and the board comes in, rather than this being this overhead thing that takes you away from the day-to-day business.
So, Annie, as an investor, founder knows that they've missed the quarter, they had a key person leave. You don't know it yet. How do you want to hear that from that founder?
In person or on the phone? Probably. You want them, well, I guess there's the how, like what's the medium, and then there's the timing, how do they do it. Ideally, ideally, if it was something they knew was going to happen, you hear about it beforehand, right? Like, I have a board that comes to mind where we think they'll miss, we collectively are concerned that numbers will be missed like 3 months from now. This is a conversation we will have had for an entire quarter by the time the number is missed, or we will have fixed it. So that's one way. Ideally, you're like having a conversation before it happens. If you had a key person on your management team who walked in that morning and said, I'm leaving, today's my last day, you obviously didn't know that was happening. How do you tell me that? You have whatever medium you want, but hopefully right then, or as soon as you have the opportunity to do so, maybe call, text, email, send carrier pigeon and say, we need you here right now. It's like, okay, I'm going to cancel my afternoon and show up. So I don't know if that's answering your question.
Anyway, what do you expect from your board members in return? You know, the question about KPIs for boards is a good one, and I've never heard it articulated quite that way, but it's hard to articulate what the KPI should be for an investor, and they'd be different for the different board members, but what do you expect from them for being on the board?
So I think what you started out with, which is board members coming in, I've had the range as well, but the ones that come in and are dictatorial or directive is a lot less productive than having your board members come in and either working through a problem together, and even at the end of the day, if it is a sort of a subversive, dictatorial type of a way, make it seem as though it's that you've gotten there, the management team has gotten there together. Because I think what ends up happening is you have board members who think, okay, this is what we should do. They're not quite as intimately involved or familiar with all of the different factors that are actually happening on the ground. And then to add that on top of it is you've got the management team also that is sometimes conflicting as to how something should be done. And so having a board member come in and kind of stir the pot when you may already have the pot being stirred internally, I think being able to recognize that and figuring out how to help the management team pull together collectively to address a problem, to hit the numbers, to figure out how to solve a big strategic decision that we need to face is probably one of the biggest ones that I have found to be the most helpful.
The facilitative board member is the board member you want, not the disruptive board member. And I'll never forget when I decided I was going to start being on boards, and I was thinking about my cast of board members at VeriSign over the years, and there was one person that I decided I was going to model on behavior after. I won't say who it was, but this person didn't ever talk to talk, didn't talk to make sure everybody knew he was the smartest person in the room. He spoke infrequently in board meetings, but when he spoke, he was concise, he had facts, and it mattered. And he either tried to solve a problem, break a logjam, or move things forward. And so I still to this day, I constantly think about that. Am I being helpful? Am I solving a problem here? Am I facilitating, like you had talked about, between management and the board? A lot of times I'm the facilitator because I've been on the other side for 12 years of the board meetings at VeriSign as CFO. And so just always trying to think about, how can you be facilitative and particularly not to be disruptive?
I might just add just to your point of, we see companies sometimes where, oftentimes it's the CEO and maybe 2 or 3 other board members at most sitting in the room. But oftentimes it's the management team that they're in the weeds, they know what's going on in any part of the business. And so oftentimes we'll have a CEO, sometimes at our suggestion, sometimes at theirs, bring in their management team or some portion of them to do that part of the board presentation of here's where we are, if it's a marketplace business, here's my head of supply, here's what they're thinking about, here are their KPIs, here's what's tracking. And now we get to have a conversation with that person, which I think does a lot of things. Both lets you have the real, on the ground insight into what's going on, because the CEO is doing a whole bunch of different things, not just focusing on supply, for example. And I think it also does great things for management teams, particularly early stage, where they're kind of like, okay, well, I'm handing off this thing that I spend every day thinking about to the CEO to go into this closed doors boardroom, and I don't know what's going to go on. But to have them come in and own it and be part of the conversation, I think is a really great way. Building relationships and getting to the bottom of things more quickly, of having proactive conversations. So I think that's something where this might be just an anecdote from my own personal experience, but I think a lot of particularly first-time founders and early VCs, quite frankly, have this vision of what a board meeting looks like. It's usually there's a rich mahogany table and lots of leather chairs and men in suits, and you're kind of like, I don't have any of the information, and I'm not a man wearing a suit, and is this going to work? As it turns out, they can be whatever they want to be, right? You can go on a walk. Maybe your board meeting is literally a hike. I've done that before. Or maybe it's like you're sitting at a restaurant somewhere and you've sent the board deck beforehand and you're just having a conversation about, to your point of like send the data early and then use the time for discussion because that's really what's helpful. I think that this idea of like what is a board meeting and is this weird scary thing that we see on, The Office or something is not actually accurate at all. So it can be whatever you want it to be and you can include, to that point, whoever you want to include.
I don't know about you, but I model our board meetings after The Office, so. I like the KPI question because I think it's probably my favorite question. Because one of the things that I think is really important is for boards to hold themselves accountable to each other, board members. And the CEO wears two hats, as board member and as CEO. And so when you look at it from a board functioning perspective, the CEO gets to participate as a peer in that discussion. I think that's really important. One of the things that I practice, I began as chair of the board that I run, it was to do the self-evaluation. And when I went and looked for best practices around that, I was pretty surprised to find that very few boards did this. And so, and it was very, very eye-opening and illuminating to self-evaluate yourself as a board member and then each other, and have that information shared in an anonymous way that felt safe. Really, really useful and valuable information came out of it, and having the CEO participate as a peer in that was also very valuable. So I'd encourage that as kind of a way of answering the KPI question.
Yeah, I would say, so it's typically only when you get to a public company that you're doing these official kind of board reviews. ISS does like you to do them. They're actually fairly taxing forms, the standard forms to do this. But I think that the leadership on the board, whether it's the CEO, if there is a lead outside director, or just someone who has the stature to be able to act as sort of first among equals on the board, can help at a minimum prevent the downside risk of bad board behavior. So what you sometimes see, I'll say, is VCs who are on too many different boards. I've seen VCs show up to a board meeting and think he was in a different company, right? So start asking questions about a different product. It happens a lot, especially when you have investors who have 10 or 12 boards. They just show up and their admin has sent them to that meeting, and they just didn't get the brain in the right gear. So that's bad behavior that probably the person will be embarrassed enough that it's self-regulate, but having your board members and your company being respectful of everybody, show up on time, right? Dial in on time, have read the material, be conversant with the facts. So someone can be the enforcer to at least get you to avoid those mistakes. Those mistakes happen all the time. Just because also probably they're happening in your company you probably have some executive who's late to meetings and you can't tolerate those companies. And then if you have a disruptive board member, right, the one who talks too much or, goes way into the weeds or, pontificates too much, as a CEO, you can ask another one of the trusted directors to help manage that relationship so that the CEO doesn't have to take on an adversarial relationship with, remember, I said this in, I think, a blog post or an article recently, your VC investor board member is you've hired your boss, only your boss has a contractual permanent right to be your boss. So you can't really get rid of him or her, but what you can do is ask somebody else on the board to help corral him or her, and either in private or even in the meeting, stop it. Say this, thank you for sharing, Tom, Dick, or Harry, but that, we're really focused on this other issue, so we're going to set that aside for right now. And those are the conversations the CEO's having, some of the conversations CEO's having in private with the other directors, and how to orchestrate the meeting. Not to orchestrate the meeting such that it's a play and everything is already pre-baked, but to know that if we get off topic, if we're running, if time is running short and we haven't got to the important topics yet, if the interpersonal dynamics are bubbling over, if the economic dynamics are bubbling over, because what will happen sometimes is if you have some investors who are in the company at a very inexpensive cost basis and some investors who are in the company at a very high cost basis, they will want to do different things with the company. And being able to, acknowledge that and manage that in meetings is really important. So as a CEO, understanding what's going to happen and find your trusted advisors on the board to help you manage those dynamics. And sometimes managing those dynamics means bringing them into the light, acknowledging them, and then kind of being able to move forward in a productive way.
Yeah, there's often times where I have to be the person that basically says, guys, because it's usually guys, why are we in the CEO's shorts on this? Like, did we not give him authority to do X, Y, and Z? He's doing that. Can we please let him do his job? And, because that's where you've got to remind the early in board members, they're not running the company. The management is running the company. We're there to, so can we please let the CEO do his job? He'll come back and let us know how it's going, and let's stop interrogating him, because it happens a lot. It happens a lot. And then the other thing too is for your independent board member, it's super important. So oftentimes you get into these discussions, challenges, et cetera, because you have early investors in at XYZ cost, middle, late stage, and everybody at some point in a growing, fast, more mature company has a different objective. So your independent director is the person, and Sharon's heard me say this, like, look guys, I don't have a dog in this fight. I don't own a big piece of your company. I'm just trying to give you the best advice I can give you based on my 100 years of experience. This is what I would recommend. Let's talk about it, because there's differing interests in the room as the company becomes more and more later stage.
How many of you are CEOs of your companies? So you have the right to set a standard for how your board members participate in your board, and Sharon touched on some of those key things. I think one of the dynamics that is important to sort of shift is that just because your board, your accountability board, your board can fire you, doesn't mean you have a deferential relationship to them. And I know I struggled with this as a first-time CEO of, gee, can I ask these busy board members to read the material in advance, to show up on time? Can I call them on it if they're not holding the standard that I want to hold? So this is the leadership of the board. It's the strategic management of the board. Management with a big M rather than little m. Little m management is really code for control. I really don't like that word, manage the board, because it's really what everybody's often talking about is, how do I control my board so they don't get in my way? And that's actually that's the low side of the nature of a board. Managing a board to the high side of their nature really comes from leading them and setting a standard and saying, here's what's expected. And I do this when I'm recruiting board members. It's like, here's what's expected. Look, we have an actively engaged board. People are deeply committed. They show up. They're available between meetings. And you just kind of say, here's the bar. And if that's a good fit with you, awesome. But here's the bar. We're not going to lower that bar. So you have a right. I just want to say you have a right to do that. And I encourage you to do that, because it will tell you who your good board members are going to be. And people are hungry for that. And the ones that show up that way it'll be energizing to them.
Can I ask a question here?
We'll hold it for.
I was just going to say one thing too that I think is super important as CEOs is have an after board meeting debrief. And whether you have time to do it that day, oftentimes people are running planes, trains, whatever, but have a debrief. How did you think the meeting went? What did you like? What didn't you hear that you wanted to hear? What can we do differently? And have that be a collaborative, symbiotic discussion as well, because that's super important to just, you're just constantly trying to make it better, more effective, higher quality. Really important to do the debrief.
Sharon and Amy, how do you manage a situation where the VC's on the board, there's more than one VC, where they disagree? Is it like parents not fighting in front of their children? Is it, no, open it out? How do you manage that?
Sure. You have more years of experience than I do, but I'll try my best. I have two situations where that's the case, and I think it's just about having open communication. This whole idea of preparing for a board meeting, it's not just the meeting, it's the before and the after too. So in any, the boards I think of where we have multiple VCs, we are always having conversations leading up to the meeting and debriefing afterwards, just the 2 or 3 of us, because it's, in some ways maybe it is like parenting where you want to show up as a united front, or you want to have full information to be as helpful and supportive as you can. So I think that there are most certainly those conversations that happen before and after, and those aren't hidden conversations. It's like, of course we're going to talk about it, because every combination of people who are showing up at that board meeting should have, I think, one-on-one conversations or relationships outside of that room.
Right, I think that that's a big part of it, is being able to have the conversations outside, so that by the time you get to the board meeting, you can be productive, you can know what the differences of opinion are, acknowledge them, and then move on, right? Because for what companies really need is to set a plan, commit to a plan, and operate to a plan. And just as if you have an executive who's stonewalling, who says, okay, yes, this is the plan, but I don't like it, and I'm not going to do it, right? Which they can say with their body language all day, even though those words aren't coming out of their mouth. And then you also find that, by the way, those features are not in the product, or those territories are not opened up, or those salespeople are not hired. That kind of not operating the plan is incredibly debilitating inside the company, and it's just, it's frustrating and grating in a board meeting. Hopefully it's not actually stopping the company from doing things, but I also think in board meetings, when you have executives present, non-CEO executives present, and there's dissension in the board ranks, then that filters through and causes all sorts of disruption and uncertainty in the management team, because then the management team doesn't know, should they listen to the CEO, should they listen to these other directors, and they don't realize that that dissenting director might be there for 3 hours every quarter and not really have very much context, and can easily be shined on, but those words that he or she says in the meeting carry a lot of weight down to the operational VP level. So I think this is, it's one of those situations where the CEO or another director can spend some personal capital on behalf of the company, making those one-on-one phone calls and trying to bridge the differences. I think everybody also has to recognize that for investor board members, we wear 2 hats. We wear a board member hat, which is we have a fiduciary responsibility to the entire shareholder base, and in sticky situations, specifically to the creditors, that is different than our fiduciary responsibility as investors to our investors. And sometimes those 2 roles are aligned, and sometimes they are at odds with each other. And you have to be able to acknowledge that, and it's a very mature board member who can say, as a director, I will approve this transaction, but I can't speak for my, but it may be that my firm is going to vote against it as a shareholder. And that, hopefully we avoid those kind of situations and figure out in advance what the company is going to do about that. But you as operational folks have to recognize that your investor board members have those 2 different jobs. And so even though something is, quote, the best for the company, and it's not the best for an individual shareholder, that shareholder base has a right to act differently than what the board is deciding.
This is why you see in preferred stock financing documents in the certificate of incorporation a long list of protective provisions that are things that require stockholder approval. And they're all important, and it's in the important situations where this tension often comes up. I'm going to shift gears for just a second, because I may never have this opportunity with this sort of a panel, but I want to ask.
I hope you get this opportunity a lot.
We'll let you pick all the panels. Why does diversity matter on boards? I mean, it's a huge topic right now for obvious reasons. But why is it important? Not just because it's April 2015.
Yeah, I'll talk on this first, because it's something that if anybody follows me on Twitter, you'll see it's a topic I care a lot about, spend a lot of time on. So Monoculture, so the less diverse an organization, typically the worse quality decisions it makes because it has blind spots in its fact set, in the setup, the constellation of facts that are used to make decisions. The narrower the population of people making those decisions, the less they know about the whole world in general. And so when you have a more diverse organization, you tend to be more open to more ideas and actually have availability, more facts, more experiences to be able to make a better quality, more informed decision. And there's tons and tons of research about decisions that are made operationally inside companies as well as at the governance level, the quality of decisions, the amount of risk that's taken, and the ability to operate about diverse organizations. The other thing is that diversity tends to lead to more diversity, and monoculture tends to get very stuck. And there's, again, a large body of research that if you have a, for example, 10-person organization and you don't yet have a female, a person of color, it becomes vanishingly small chance that you will be able to attract one of those types of people as the organization grows. So the more white men you have, the harder and harder it becomes to change the ratio, right? Which is hashtag for this topic. So starting early with an intention to build diversity will give you both the chance to have that for the long run and also an early head start on your competition in having the kind of organization that will make high quality decisions. So one of the reasons, I'll give a couple of examples of why I think this is important. One, operationally. I personally do subscribe to the Mark Andreessen quote, software is eating the world, right? Software is the coding by which we experience so many different things in the world, right? It's how we drive our cars. It's how we operate, for example, our appliances at home is all now drive-by-wire. I bought a new toaster oven. My toaster oven, when the toast toasts, has an alarm that goes off that I swear is like the start of World War III. There's no feature that allows me to turn it off or turn it down. I guarantee you that a person who was at home with an infant did not design that toaster, right? But it's probably a large use case, but somebody didn't design it that way and somebody didn't QA it that way. So they just miss an opportunity to delight their customers. And then that's a tiny example, but there are many more. A different example, that's a board level example. I happen to be the only woman on the board of a company that's a relatively mature company, has no women management. It's a relatively mature company. We've all been investors a long time. It's a good company, not a freaking awesome company that you want to just keep compounding forever. The time has come. Funds, there's one fund there that's completely out of money. The time has come to realize the opportunity, realize the investment, sell the company. Everybody agrees this is true. When we have the one-on-one conversations, because I do this every board meeting, one-on-one conversations with each of the directors and the CEOs, everybody agrees, yep, this is the year we should sell the company. It's going to get older faster than it's going to get better faster, right? So we should crystallize now. Then you get in the board meeting, and the CEO says, in the strategic plan, because we're going to sell the company this year, we're going to do X, Y, and Z. And all of a sudden, the personality transplant comes to all these manly men board members. What do you mean we're selling the company? We're here to build a company. We can take it public. We're doing $20 million in revenue, growing 20% a year. By the time we compound to a public company, my teeth will have fallen out. But it's sort of like the presence of all these men, and they happen to all be all very athletic. The just goes through the roof. And I'm a competitive athlete too. I can run with these guys, but they just, in front of each other, they cannot get out of that competitive mode. And it happens almost every quarter that we go through this, we're going to sell the company. What do you mean we're going to sell the company? And then you have to go and sort of repair after the board meeting again. And it's so tiring. But I think that it's, that's just one of these examples where everybody puts their game face on and forget that they're actually there on behalf of the whole company, on behalf of the employees, on behalf, even for their own funds benefit.
Others?
So I obviously think diversity is important. I'm thinking through my boards. Most of my boards, I'm the only female. I mean, the board chair and I sit on, there's 3 of us, which is shocking. But I also really feel, and I, you know, it's been such a hot topic the last, call it 15 to 18 months, so just constant interviews, newspaper articles, whatever. It's also super important, though, that you hire a board member because they're qualified for the job, not because you're trying to find a female. And so I've seen in a couple instances where people are so focused on finding a female that they're not actually stepping back to the first level order, which is, what is your board composition strategy? What are you looking for around the table? So I think that's the important thing. And then absolutely, you should be looking at female candidates, diversity candidates. I mean, that should be part of the process. But I think it has to start with, what is my board composition strategy? I think somebody had this question. So as you look at an early stage company like what Amy and Sharon invest in versus like later stage companies, the composition of the board changes over time, right? And so you start out with your venture capitalist, you have your first independent board director, but ultimately, and I sit on most of the non-gov committees of my public companies, your board table should consist of either a former or a sitting CEO who can be a mentor to the CEO that's there. You need your financial expert, CFO, etc. And then typically the next person I see hired either is the technical person, so it's a CTO or CIO, and as the company becomes even more mature, what I really like to see is the voice of the customer. So that you have somebody who's the voice of your customer, who's really helpful around product strategy, go-to-market strategies, etc. And so in looking for those people, I think it's important that you look at diversity, but I don't think you should pick somebody who isn't qualified for whatever that slot is. You know, and I sit on the board of a company in Paris, and they have a 40% female role. And you know, there's a lot been written about Germany just adopted it as the Netherlands. But when I go to those board meetings in Europe and we all sit around and talk about it, they're having a hard time finding women to sit on some of these boards. And so then what's happening is you have boards that end up with people who really aren't qualified and are helpful to the company. So that's the other side of it. It's not necessarily good.
Yeah, well, first I want to just start by acknowledging some of the objectively, kind of the legitimate challenges and tensions around this issue, which is that, you know, we talked about trust in amongst boards, we talked about chemistry, and that being so important. So one of the kind of, and you're talking about companies that are time pressured, you're under the gun, and all those things can conspire to say, what's the fastest, most efficient way to solve for chemistry, to solve for trust? Well, it's going to be typically, who are the people who I know have, we talked about having pre-existing relationships, right? Who are the people I know that I trust, that are known quantities to me? And so it is easy and natural and practical to see that this leads to homogeneity on boards. And so I just want to acknowledge that as kind of the backdrop that we're dealing with, not because people have these sort of nefarious reasons for trying to keep boards that way. Maybe there are a few, but we won't talk about them. Largely, so that's kind of the challenge, is that, you know, sometimes homogeneity is sort of, I call it lazy man's solution for chemistry, because it's easy to get there that way. So if you're trying to break out of that, say, why is this important? Why would it be important? Because it might take longer. It might be, it may mean going outside of a network that is known to me. I think it really gets back to, if you are trying to immunize your company against unknown threat and identify opportunities that may not be obvious to you, having the most diverse thoughts in the room and background is going to set you up for that, is going to maximize chances of success around that. So to me, it's about diversity of thought and background experience. You know, I am an Egyptian immigrant. I'm sort of a citizen of the world. I live half of my time for a long time in Europe. I spent my formative years in the deep south in Alabama. those experiences actually changed the way I think about things. They shaped my view. And I can see it when I'm sitting next to somebody. I've been in the Bay Area 20 years. I can see when I'm sitting next to somebody who grew up here or grew up in a different part of the country. And when we talk, we really have an expansive conversation. So it's really about that. That I think kind of the gender discussion is the most useful to have. And when you think about it in that backdrop, you say, why would we want to have a board that's making kind of the most important strategic decisions for a company and have half the population's perspective not represented? That just doesn't seem like a strategic thing to do. And I think, in 5 years or maybe sooner, it'll just be kind of, we won't even have to ask this question, but right now just making the implicit explicit, I think ends up being useful. So the diversity of thought and experience and it is what we find valuable. There are plenty of women who don't have that. So there's the symbol of diversity, which is I now have a woman on my board, and then there's true diversity. And I can tell you, I know Sharon well. I've never met these other amazing women, but I can tell you, I can say with confidence, none of us want to be associated with being a symbol for diversity. We want to know that we're there for substantive reasons, and we're also happy to be role models for amplifying this so that more women are viewed in that role, but not just for that alone. So it's really important for that kind of substance around the thinking and the experience and getting clear about why do I want this person here. There are plenty of men that bring a diversity of thought and experience, and there are plenty of women who are not as connected to that part of themselves, and I think it's just really important to get underneath the layers. And then the last thing I'll just say is that one thing I have found, I think where we're really trying to get to is a more humanistic way of doing business. And so when you have both genders at the table, when you have different cultures at the table, what we draw on to solve for problems is sort of the commonality of human experience. And when you do that, what I see is that the men at the table, their humanity comes forward and they feel like they have permission to lead with that. And the women feel like they have permission to lead with that, because a lot of us, if we are in male-dominated environments, will often put a lid on that stuff, and we show up in our power suits and our hyper-analytical left brain thinking, which has its place, but also business is personal, and getting back to, okay, I'm dealing with this human being, and if they're not bought in, if I don't know what makes them win right now in this moment, I'll have zero influence over them. So how do we deal with the person and the feelings behind this issue while we're dealing with the issue too? I just think when you have a mixed gender group, that's more likely to happen.
We'll do a Q&A, and then we'll close it. Questions?
What advice do you have for CEOs dealing with a terrible board member?
So define terrible. You may have so many meetings.
I can't use any names.
Well, no. What's the behavior?
Like, there's really wonderful board members. You all seem to be really wonderful. There's board members that are facilitative, not disruptive. There's board members that bring deep insight into some challenges the company's facing and needs to overcome. And then there's board members that seem to be like almost self-destructive and like want to cause problems. And maybe it's because they want to be the smartest person in the room, so they talk about things, and they don't have anything intelligent to talk about, so they just talk about something, or they like to stir up conflict amongst management and amongst other board members. They just seem to enjoy causing trouble.
And this is like one of your primary investors.
Yeah, so like when I say like,
it's a friend.
Looking for the
Asking for a friend.
Well, no, because if you're, I'm a super direct person. It's probably not. I would take the person out for breakfast, lunch, coffee, whatever, and have a personal conversation. And it's hard. You might want to script it ahead of time, but like it's like this seems to be, this is not that effective. Tell me what, you know, I mean, I would have a one-on-one conversation. Now, if you have a chairman or a lead independent director or a lead investor, you may want to have them have that conversation first. I'm usually the board member that gets asked to have that conversation with the bad board member, but.
Yeah, I can offer some practical tips. So if it's an outside director, so you can find a way to remove the person, and the easiest way to remove the person is to replace them. So by saying, if your articles of incorporation call for a 5-person board, if you miraculously materialize the next set of talent that the company needs, you can leave the person you want to get off with respect by saying, I've found the next director our company really needs, and I need to ask you to step down from your board position so that I can bring this new person on into the seat. So that's kind of the face-saving way of removing a person who does not have a contractual right to the seat. Okay. Sounds like your problem is it's an investor board member who has a contractual right to that seat. So that is a
problem.
Huh?
Your friend's problem,
Your
not your problem.
Yeah. Okay. In the hypothetical case. So there's a couple of different things that you can do. One, so that's an area where it often really pays to have the other professional investor board members help be enforcers against the bad behavior of their peers, right? So because you can't, you can have those kinds of conversations, and a non-threatening way to say is, this seems stressful. Instead of saying you're a dick, you can say, this seems stressful, or we're not meeting, maybe we're, is there something that we're not doing? You can ask those kind of humble questions and say, like, why are you such a jerk in the board meeting? It's the subtext, but there are respectful ways to ask the question. So having the other investors enforce that. So other tricks are, as you raise new capital, the next prospective investors will ask you, they're smart, they're going to ask you when they're crafting the term sheet, what should I know about the board dynamics? Is there something you want to do? So it's really only at financings do you really have a chance to change who has a right to a board seat. And you can't force an early director to give up a board seat unless that is the terms of the capital, of the new capital coming in, and you have to have the new capital. So then that, it may be that the board member has to vote for the term sheet, even though as an investor he doesn't like it. So, and this is an area where it takes some real finesse, because to the new investor you don't want to say, hey, I'd like to knock off this guy, could you please do it for me? Because then the new investor is going to wonder, well, what is it going to be like to work with this CEO the next time around, right? And are you a control freak and all that kind of stuff. But as the capital base grows, you really don't want to be giving, one board seat for every round of capital, or much less, sometimes the Series A starts with 2 directors, and often if the company's successful, everybody wants to cling on to their board seat. So it's pretty normal to start shrinking the number of investor director positions as the capital base grows. As a last resort, you can go to the firm. If you have a relationship with the firm that the director is from, you can go to the firm and say, find it, again, you have to find a really respectful way to say, we'd like to bring some additional expertise, or there is somebody here who we'd love to work with. But you really can't say, I don't like this person, could you please give me a different director? Because if you lose that battle, it's going to be really, really unpleasant for you for the rest of your life. So,
if you're going to shoot the king, you better kill the king.
Yes, exactly. If you're going to take a headshot, make sure you hit the mark. So that's why I said that's the last resort, right? Because also you don't want to be tattling on a board member to his or her firm, and you want to make sure that you are going to materialize that transition.
You just brought something to mind, Sharon, that as you're doing these rounds, you're going to get asked to, well, we want 1 board seat and an observer, and we want 1 board seat and an observer. And if you're not careful with saying no to the observer, you're going to end up with the UN sitting around your table. And then what happens is the observers bog down the meetings, and they're not observing. And so, one, I try to limit observers, and then make sure if you have them, they understand they're observers. And so the other conversation I get asked to have a lot of times with the observers is, you need to observe. Like, you just took 25 minutes of our 3-hour meeting asking questions that none of us had and didn't care about. And so it's, again, but it's gotta be communication. People need to understand what their role is, what their duties are, what their participation is. And so I would caution against, because it's easy to say, oh yeah, sure, you can have an observer seat, and then the next thing you know, there's like 6 observers sitting around the room, bogging down your meeting, not adding value.
Other questions?
So I think we touched a bit about this, but I'd like to kind of get your thoughts as you've been in situations where actually there has been conflict on the board. And the board members may have different goals for different reasons, and they may not agree. So who takes responsibility for getting everybody aligned? And what happens when it doesn't?
Well, I think this is, one, you want difference of opinion and what I call creative tension. And the way that gets managed is determines whether it devolves into conflict. And so if you so there's proactive, reactive. Proactively, creating the conditions and environment for different points of view to be brought out, for there to be comfort around that, and a healthy, constructive discussion is kind of a good board culture to create. Now, there are always times where you get to where, okay, we're gridlocked around an issue and you have kind of different differences of opinion. And what I find really key there is, whether it's the CEO or the chair or both, depending on whether you have a chair, is that so much of this is about understanding what's behind the conflict. Like, what's really going on? There's always these sort of multiple layers of conversation. There's the debate being had, and then there's what's underneath it. A lot of times what I find is there are either personal motivations or biases that are driving a certain point of view, that if you can get underneath them, you start to be able to find common ground or dismantle them. And so it's kind of that shadow boxing that can happen, and you have a tight meeting that's unforgiving, people are kind of, back and forth, quick conversation. So offline conversations, what I find very useful is when things are gridlocked and you can't resolve right there in the meeting, offline conversations, one-on-one with each stakeholder, can say, where are they coming from and why? And then where's the common ground? And oftentimes, when the conflict comes is when people are communicating conclusions rather than participating in a discussion. Right, so then you sort of, how do you back the group away from talking about conclusions and remind, okay, what's the problem we're trying to solve? What's the common goal we share? And then where are assumptions being made, and just unpacking that progression.
Yeah, one of the things I like to do when that happens is turn to the CEO and say, what do you want to do? Tell us again what you want to do and why. Because a lot of times it's all about personal interest and personal conclusions and things. And so if you bring it back to the CEO, okay, we've gone round and round on this. What do you want to do? You're the CEO of the company. And then you take the dialogue from there.
We are, I think, at the end of it. So please join me in thanking the panelists.